Hello, class. This week we will learn about what happens when a company's customers don't pay their bills. Our objectives in this chapter are to understand the process of determining and writing off uncollectible sales on account, to learn the accounts used in this process and how the value flows through those accounts, and to apply this knowledge through practice exercises. Let's begin practice exercise 1 together on page 222. We are given a list of accounts receivable for the company Dominion Importing Company as at December 31st, 2025. The terms on all sales are net 30 days. We will take the invoice dates by client name and count the days between then and today, which is December 31st, 2025, to create a schedule of aging accounts receivable. First, we have to count the days between the invoice date and December 31st. I would write that information directly in the textbook beside their names at the bottom of page 222. For example, beside Conrad and Dosa, write 174 because there are 174 days between July 10th and December 31st. You can create a table by hand on any piece of loose leaf paper, or you can do it using a computer spreadsheet program like Excel. Create a table like the one shown. Once you have the number of days for each account, pull that information across into the columns on the right for each aging period. Conrad Andosa's account is 174 days past the invoice date, therefore his amount goes into the over 90 days past due column. Do this for each account. Next, we need to identify the percentage of each aging period in relation to the total accounts receivable. See the bottom totals. $15,033.90 is due to Dominion Importing Company from all of their customers. Of that amount, $12,016.15 is not yet due. $1,004.50 is 1 day to 30 days past due. These are all the amounts where the number of days since the invoice date is 31 days to 60 days, because remember, not yet due is actually 0 to 30 days. $783.10 is 31 to 60 days past due, so that is all the accounts where the number of days since the invoice date is 61 to 90, and so on. Next, how do you think we determine the percentage each column represents? We take the total for each column and divide it by the overall total of $15,033.90 to determine the portion of receivable that each aging period represents. The vast majority of accounts receivable are not yet due, 79.9% to be exact. 6.7% of all accounts receivable are 1 to 30 days past due. 5.2% are 31 to 60 days past due. 4.5% are 61 to 90 overdue, and 3.7% are over 90 days past due. Next, we need to identify the information that we need to further analyze. Take the description of the aging periods, which are the headings shown here, and their respective totals at the bottom. Plug this information into a new table that looks like this. Copy the percentage of total amount due over from your original table. Now we need to do some calculations. Step B on page 223 gives you the rates of uncollectible amounts by aging period. Enter those into your table. Then multiply the amount due for that aging period by the estimated percentage of uncollectible. $12,016.15 times 1% equals $120.16. $1,004.50 times 4% equals $40.18, and so on. The total amount estimated as uncollectible is the sum of these amounts, which equals $650.97. Sometimes numbers can be confusing. to look at this information in an illustration, we can view it as a pie chart. On the left, we see the breakdown of amounts due by aging period. And on the right, we see the breakdown of amounts estimated uncollectible by aging period. The largest amount calculated as uncollectible, 50% of accounts over 90 days past due, comes from the aging period with the lowest amount due. $554.30 is less than any other aging amount total, and multiplied by 50% gives us $277.15, which is the largest amount of the estimated amount of uncollectible. And we can see that the total estimated uncollectible of $650.97 is significantly less than the total due of $15,033.90. In fact, after all our calculations, the final estimated uncollectible amount of $650.97 is only 4% of the total accounts receivable. Next, we have to decide what to do with this information. What is useful for our client? We are the bookkeepers for Dominion Importing Company. What do bookkeepers do? We create journal entries. Remember when we first talked about contra accounts when introducing GST? GST payable is an amount collected from customers that has to be paid to the government. GST input tax credits are amounts paid out by the company to suppliers for GST that's been paid on their expenses, and this amount gets deducted from GST payable. GST ITCs are a contra account to GST payable because it reduces the full value of GST payable, making the amount due to the government less. GST payable is a liability with a normal balance being in the credit position, so the contra account has a normal balance in the debit position to offset that. In much the same way, allowance for doubtful accounts acts as a contra account to the asset account, accounts receivable. The accounts receivable account as an asset has a normal balance in the debit position. As its contra, the allowance for doubtful accounts has a balance in the credit position to offset it. The difference between the accounts receivable account and its contra account, the allowance for doubtful accounts, is what the company actually expects to receive from customers. All right, now we get to create a journal entry that records on the books for Dominion Importing Company the amount on the balance sheet that is contra to the accounts receivable. Why is this useful? Well, for a company that has their balance sheet and say they go to the bank for a loan or something like that, they need to show the bank all the things they own, the amounts that they owe, and the equity is the difference. Going back to our basics of the balance sheet, assets equals liability plus equity. But what happens is, in that accounts receivable amount, the company knows that they're not going to receive that full amount. So an accurate depiction of what they own and what they owe is to have this contra account for allowance of doubtful accounts that has an estimated amount that they won't be receiving. So remember that as a contra account, the allowance for doubtful accounts normally has a credit balance. So assets normally have a debit balance, but because this is a contra account, it's going to have a credit balance to offset accounts receivable. So we know that in step 1 of determining which accounts to debit and which to credit, that it will be the asset account allowance for doubtful accounts that will get credited. Now, what gets debited? The related expense account gets debited. There exists an account within the books called bad debts expense, and this is where write-offs of uncollectible sales invoices get recorded. Our December 31st entry for Dominion Importing Company will expense the amount that they expect to be uncollectible, even though they don't know yet which customers will actually end up not paying. This is all based on the management's experience with their customers, and it is the managers who give the bookkeeper those percentages of expected uncollectible. We know that bad debts expense will be debited and allowance for doubtful accounts will be credited. Now, by how much? The amount we use is the total expected uncollectible that we calculated in the previous steps, $650.97. What does this look like? a basic journal entry with the debit line first and the credit line second. Add a comment to the journal entry, such as to allow for estimated uncollectible accounts receivable. And then we have completed the process. You now know how to calculate the estimated uncollectible amounts from a client's accounts receivable balances. Thank you. Go ahead and try and tackle this question on your own and continue forward with the other related practice exercises.